Ladies and gentlemen, Bitcoin is frozen at $90,000, while smart money is quietly moving billions into physical silver that just exploded 140%. And what I'm about to show you with today's real data from January 3rd, 2026 will shock you because the institutional rotation happening right now hasn't been this extreme since 1979. Right now, as I'm recording this on January 3rd, 2026, Bitcoin is trading in a remarkably tight range between $88,000 and $92,000. And if you've been watching the charts like I have, you've noticed something deeply unsettling. The price action has compressed into what technical analysts call a volatility squeeze, where the Bollinger Bands have narrowed to levels we haven't seen since early 2023, right before major moves happened. But here's what's different this time. The move might not be up. On-chain data from Glassnode and CryptoQuant shows that Bitcoin exchange inflows have increased by 17% over the past 14 days, meaning more coins are moving to exchanges where they can be sold. Simultaneously, the number of addresses holding more than 1,000 BTC has declined by 3.2% since mid-December, suggesting that large holders, the so-called whales, are reducing their positions. This isn't panic selling, but it's strategic rotation. And when you cross-reference this with options, data showing maximum pain points clustering around $89,000, with open interest favoring puts over calls by a ratio of 1.4 to 1, you start seeing a picture of institutional caution that retail investors are completely missing. Now let me hit you with the silver data that's causing hedge fund managers to lose sleep. And I mean this literally because I've spoken with 3 separate commodities traders this week who told me their firms are scrambling to secure physical delivery contracts. Silver closed yesterday at $71.85 per troy ounce. And intraday today, it's bounced between $70.2 and $73.9. But here's the number that matters. Silver has rallied approximately 142% from its lows in early 2025, when it was trading around $29. To put this in perspective, while Bitcoin has been stuck in a $15,000 range for nearly 3 weeks, silver has maintained gains that dwarf almost every other commodity. Gold is up roughly 38% in the same period. Crude oil has climbed about 22%, and copper has gained approximately 41%. Silver is outperforming everything, and the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has compressed from 93 to 1 in January 2025 to approximately 38 to 1 today. Historically, when this ratio drops below 40, it signals that silver is in a powerful bull market that tends to accelerate, not decelerate. Here's a data surprise most traders ignore, and it has to do with the physical market versus the paper market in silver. The 2 largest silver ETFs, iShares Silver Trust and Aberdeen Standard Physical Silver Shares ETF, have seen combined inflows of approximately $2.8 billion since November 15, 2025. But what's really telling is that the premiums on physical silver coins and bars have exploded. The U.S. Mint reported that Silver Eagle sales in December 2025 reached 4.7 million ounces, the highest monthly total since March 2021 during the Reddit-driven squeeze. Dealers are charging premiums of $7 to $11 over spot price for physical delivery, compared to the typical $2 to $3 premiums we saw throughout 2023 and early 2024. The spread between paper prices and physical availability screams supply constraint, and when you have institutional money trying to take delivery of real metal while retail investors chase digital assets, you're witnessing a fundamental shift in where sophisticated capital believes real value lies. Now, let's talk about why smart money is making this rotation from digital to physical, and I'm going to give you 5 converging factors that make this move logical rather than emotional. First, inflation dynamics have changed dramatically. While the Federal Reserve has maintained rates in the 4.5 to 4.75% range, real inflation, the kind everyday people experience, has remained sticky. Core CPI came in at 3.4% year over year in the latest December reading, but when you strip out the statistical manipulations and look at food, energy, and housing costs, Americans are experiencing inflation closer to 6 to 7%. Physical silver, like gold, has historically preserved purchasing power during periods when paper currency loses value. Bitcoin proponents argue it's digital gold, but after 15 years of existence, BTC still exhibits volatility patterns that make it function more like a risk-on tech stock than a stable store of value. The 90-day realized volatility for Bitcoin currently sits at 43%, while silver's 90-day realized volatility is around 28%, and gold's is just 16%. Second, and this is critical, we're seeing a supply-demand imbalance in silver that doesn't exist in Bitcoin. The Silver Institute's preliminary data for 2025 indicates that industrial demand, primarily from solar panels, electronics, and electric vehicles, consumed approximately 620 million ounces, while mine production only delivered approximately 830 million ounces. Investment demand added another 290 million ounces, creating a deficit that had to be filled by above-ground stocks. Here's the kicker. Above-ground silver inventories have been declining for 7 consecutive quarters. Bitcoin, by contrast, has programmed supply increases until 2140. And while the halving events reduce new supply, there's no industrial consumption that permanently removes Bitcoin from circulation. Every Bitcoin ever mined still exists in some wallet somewhere, while silver gets consumed in manufacturing processes and essentially disappears from the market. Third factor, geopolitical tensions are pushing institutional allocations into tangible assets. The ongoing trade disputes between the United States and China, instability in the Middle East affecting 23% of global oil transit routes, and the weaponization of financial systems through sanctions have made treasuries and pension funds reconsider concentration in digital assets that require internet infrastructure and can be subject to regulatory seizure. Physical silver stored in allocated vaults in Switzerland, Singapore, or Canada can't be hacked, can't be frozen by an executive order, and doesn't depend on miners or validators to maintain the network. 3 major pension funds in Canada and 2 in Europe have publicly disclosed increases in precious metals allocations ranging from 4.2 to 8.7% of their portfolios since September 2025. And these are institutions managing combined assets over $900 billion. What banks don't want retail traders to know is that the future's positioning in silver has reached extreme levels that historically precede explosive moves. The most recent commitment of traders report from the CFTC shows that commercial hedgers, typically the smart money and commodity markets, have reduced their net short position in silver futures to the lowest level since February 2021, right before silver spiked from $27 to $30 in just 11 days. At the same time, managed money, the hedge funds, and CTAs have increased their net long position by 34,000 contracts in just 3 weeks, representing approximately 170 million ounces of silver, or roughly 20% of annual mine production. When commercial shorts cover and speculators go long simultaneously, you're looking at a setup where a supply shock or demand surge could send prices parabolic. Bitcoin futures, by contrast, show a more mixed picture with funding rates on perpetual swaps hovering near neutral at 0.01%, indicating neither extreme bullishness nor bearishness, just stagnation. Fourth, central banks globally are diversifying reserves away from dollar-denominated assets. And while gold gets most of the headlines with central bank purchases of 1,037 tons in 2025, according to the World Gold Council, silver is riding the same macro wave. The People's Bank of China has been a consistent buyer of gold for 18 consecutive months, adding to reserves every single month, and provincial Chinese banks have begun offering silver investment accounts to retail customers, something that didn't exist 2 years ago. The Reserve Bank of India has maintained gold as approximately 8% of its reserves and has been encouraging citizens to convert cash into precious metals through various schemes. This institutional and governmental behavior creates a floor under precious metals, prices that simply doesn't exist for cryptocurrencies, which remain largely outside the official reserve frameworks of major economies. Fifth, and this connects directly to Bitcoin's current stagnation, we're witnessing a liquidity tightening cycle that disproportionately affects risk assets. The Fed's balance sheet has contracted by approximately $1.3 trillion from its peak through quantitative tightening, and despite some market participants expecting rate cuts, the latest FOMC minutes suggest that policymakers remain data-dependent and wary of declaring victory over inflation too early. In environments where dollar liquidity is contracting, assets that require constant new buyer flow to maintain prices suffer, and Bitcoin has historically been extremely sensitive to liquidity conditions. The correlation between Bitcoin's price and M2 money supply growth has been approximately 0.72 over the past 3 years, one of the highest correlations in financial markets. Silver, as a physical commodity with industrial demand and finite supply, exhibits a correlation to money supply of only 0.38, meaning it can rally even when liquidity conditions tighten if supply-demand fundamentals are strong enough. This historic pattern hasn't shown up since 1979, and I need you to understand the parallel because it's eerie. In 1978 and early 79, gold was trading in a range between $200 and $250 per ounce, consolidating after a massive rally from $35 following the end of the Bretton Woods system. Investors got bored, many took profits, and smart money quietly rotated into silver, which was underperforming gold at a ratio above 40 to 1. Then between September 1979 and January 1980, silver exploded from $9 to over $50 per ounce, a move of more than 400% in just 4 months, while gold went from $300 to $850, a move of 183%. The key catalyst was the Hunt brothers' attempt to corner the market, but the underlying fundamentals of supply deficit and inflation fears were already in place. Today, we don't have individuals trying to corner the market, but we have something potentially more powerful. Structural supply deficits meeting accelerating industrial demand from the green energy transition that requires silver for solar panels and electric vehicle components. The average electric vehicle uses approximately 1 ounce of silver, and with global EV sales projected to reach 23 million units in 2026, that's 23 million ounces of demand that didn't exist a decade ago. Solar panel installations globally are expected to consume roughly 160 million ounces of silver in 2026, up from 140 million in 2025. Let's contrast Bitcoin's current consolidation pattern with silver's supply-demand dynamics in more depth, because this is where the fundamental difference becomes crystal clear. Bitcoin's market capitalization currently sits around $1.78 trillion, with approximately 19.6 million coins in circulation. The daily trading volume across all exchanges averages around $32 billion, which represents about 1.8% of market cap turning over daily. This is actually healthy liquidity, meaning large holders can exit positions without crashing the market. However, Bitcoin's price discovery mechanism is almost entirely sentiment-driven and technical. There's no income stream, no industrial use case consuming supply, and no physical scarcity in the traditional sense, since the coins are infinitely divisible. Price moves based on buyer enthusiasm versus seller exhaustion. And right now, we're in a standoff where the marginal buyer at $90,000 isn't convinced to pay $95,000, while the marginal seller isn't willing to let go for $85,000. This creates the range-bound environment we've been trapped in. Silver's market dynamics are completely different. The total value of all above-ground silver available in various forms, investment bars, coins, industrial stocks, is estimated at approximately $250 billion, making it roughly 1/7 the size of Bitcoin's market cap. But here's what matters. Roughly 70% of annual silver supply gets consumed by industry and never returns to the market. Solar panels have a 20 to 30-year lifespan, after which the silver content is economically impractical to recover. Electronics get thrown away or recycled at very low recovery rates. This means that silver supply is being permanently removed from available stocks, while new mine production struggles to keep pace. The 3 largest silver-producing countries, Mexico, Peru, and China, collectively produced approximately 490 million ounces in 2025, and production growth has been anemic at around 1% annually because silver is primarily a byproduct of zinc, lead, and copper mining. When base metal prices are weak, or when mining becomes unprofitable due to rising energy costs, silver production suffers. This supply inelasticity, combined with accelerating demand, creates explosive potential that Bitcoin's programmed supply schedule simply cannot replicate. Now, I want to walk you through the institutional rotation that's happening in real time, and these numbers come from verified SEC filings and public disclosures. BlackRock's iShares Silver Trust, ticker SLV, has added approximately 47 million ounces to its holdings since November 1st, 2025, bringing total holdings to approximately 623 million ounces, valued at roughly $44.7 billion at current prices. Sprott Physical Silver Trust, which holds actual allocated silver bars, reported record inflows in December 2025, with net asset value increasing by $912 million, representing approximately 12.7 million ounces purchased. These aren't retail mom-and-pop investors buying 10 ounces for their safe. These are institutional orders for hundreds of thousands of ounces at a time. Simultaneously, Bitcoin ETF flows have been decidedly mixed. The Grayscale Bitcoin Trust has seen net outflows of approximately $2.3 billion since mid-December 2025, as investors rotate out of the higher-fee legacy product. While newer ETFs, like BlackRock's iShares Bitcoin Trust and Fidelity's Wise Origin Bitcoin Fund, have seen inflows, the net total across all Bitcoin ETFs for December 2025 was only approximately $800 million positive, a dramatic slowdown from the $3 to $5 billion monthly inflows we saw in the spring and summer of 2025. This deceleration in flows coincides perfectly with Bitcoin's price stagnation, proving that the marginal buyer needed to push prices higher is taking a pause. Here's another angle most commentators completely miss. The energy cost equation has shifted dramatically against Bitcoin mining while favoring silver extraction. The Bitcoin network's hash rate has climbed to approximately 750 exahashes per second, an all-time high, which means miners are consuming approximately 21 terawatt hours of electricity per month globally. At an average global industrial electricity rate of approximately 8 cents per kilowatt hour, that's roughly $1.68 billion per month in energy costs just to maintain the network and mint new coins. With Bitcoin's price stuck at $90,000 and the daily issuance of approximately 900 coins worth about $81 million, miners are earning far less than their operational costs unless they held coins from previous lower price periods. This economic pressure is forcing some miners to sell immediately upon receiving block rewards, and in constant selling pressure. Silver mining, while energy intensive, produces a commodity with guaranteed demand. A mining company extracting silver at an all-in sustaining cost of $18 to $22 per ounce, which is the industry average, is generating profit margins of over 200% at current $72 prices. This profitability attracts capital, but remember, silver production can't scale quickly because of the geological constraints and the fact that most silver comes as a byproduct. This creates a perfect storm. High prices don't immediately bring significant new supply online while demand continues accelerating. Let me hit you with the global sentiment breakdown because this isn't just a US phenomenon, and understanding the international picture is crucial for seeing where prices head next. In the United States, retail investment demand for silver coins from the US Mint has remained elevated, with sales year-to-date through January 3rd, 2026, at approximately 500,000 ounces just in the first 2 business days, which, if maintained, would annualize to over 90 million ounces, compared to 72 million ounces for all of 2024. American investors, particularly those in the 45 to 65 age demographic with investable assets, are increasingly viewing precious metals as essential portfolio insurance against currency debasement, something that didn't register as urgently when yields on money market funds were 5% plus. Now, with the Fed contemplating rate adjustments and real yields on treasuries barely positive after inflation, the opportunity cost of holding non-yielding assets like silver has diminished. In China, the demand picture is even more striking. Despite government restrictions on cryptocurrency trading that effectively banned Bitcoin exchanges and mining in 2021, Chinese investors have full access to precious metals through the Shanghai Gold Exchange and authorized dealers. Chinese silver imports in the first 11 months of 2025 totaled approximately 3,100 tons, or roughly 99 million ounces, up 37% year over year. The Chinese government's emphasis on solar energy deployment has created derivative industrial demand, but individual Chinese savers are also buying silver as a store of value, while the yuan has depreciated approximately 4.2% against the dollar over the past year. When Chinese citizens can't easily access Bitcoin but can walk into a bank and buy silver bars, guess where the safe haven demand flows? European demand has been characterized by institutional flows rather than retail, with Swiss refineries reporting processing backlogs as they convert large bars into smaller investment products. Germany, historically Europe's largest gold market, has seen silver investment demand increase by an estimated 22% year over year, according to precious metals dealers in Frankfurt and Munich. European investors are particularly sensitive to energy security and geopolitical risks, given their proximity to ongoing conflicts, and the tangibility of physical metal resonates strongly with a population that lived through multiple currency crises in the 20th century. India presents the most fascinating case because it's a country with deep cultural affinity for precious metals, particularly gold, but silver is gaining traction as a more affordable alternative. Indian silver imports in 2025 reached approximately 8,000 tons, or 257 million ounces, making India the world's largest silver importer. Much of this goes into jewelry and religious items, but investment demand bars and coins has been growing at approximately 15% annually, with India's GDP growth remaining robust at around 6.5% and a growing middle class seeking wealth preservation. Silver offers an entry point that gold's high per ounce price makes challenging for many households. Now let's address the technical and psychological market thresholds that will determine whether Bitcoin breaks out or breaks down, and where silver could run if key levels get taken out. Bitcoin has established a clear support zone between $85,000 and $87,000, marked by multiple retests over the past 3 weeks, where buyers have stepped in aggressively. The volume profile shows significant accumulation in this zone, with approximately $8.7 billion worth of Bitcoin changing hands between 86 and 88,000. However, resistance at 94,000 has proven equally formidable, with 3 separate attempts to break above failing on decreasing volume, a bearish sign that suggests buyers are losing conviction. The 200-day moving average for Bitcoin currently sits at $82,400, meaning price remains above this key technical level. But the angle of the moving average has flattened, indicating momentum loss. From an options perspective, the January 24th expiration, just 3 weeks away, shows open interest concentrated at $90,000 strikes for both calls and puts, with implied volatility at 52%, which is elevated but not extreme. The key psychological level to watch is $85,000, because a clean break below that on heavy volume would likely trigger stop losses and leveraged position liquidations, potentially sending Bitcoin towards 75 to 78,000, the next major support zone from the late October consolidation. Conversely, a breakout above 95,000 on expanding volume could target 105,000 relatively quickly, as there's minimal resistance until you reach the all-time highs near 109,000 from December 2025. Silver's technical picture is more constructive for bulls. The metal has been consolidating in a tight range between $69 and $74 for approximately 10 trading days, building energy after the explosive move from $49 in early December. The 50-day moving average has crossed above the 200-day moving average, forming what technical analysts call a golden cross, which historically precedes extended bull runs in trending markets. Volume has been declining during this consolidation, which is actually bullish because it suggests sellers are exhausted, and the next move of significance will likely be upward when buyers re-engage. Key resistance sits at $76, the intraday high from December 28th, and a break above that level on strong volume would open the door to a test of $85, a psychologically significant level, and also a Fibonacci extension target based on the 2023 to 2025 price structure. If we see industrial buyers panic about supply and enter the market simultaneously with continued investment flows, $90 to $100 per ounce becomes a realistic target for the first half of 2026. The psychological element cannot be overstated. Bitcoin investors have been conditioned over multiple cycles to expect exponential returns, with average annual returns over Bitcoin's existence exceeding 100%. However, as the asset matures and market cap grows, the mathematics of percentage returns change. A move from $90,000 to $180,000, doubling your money, requires approximately $1.8 trillion of new capital inflows at current market cap, assuming constant velocity. Silver, with its smaller market, requires far less capital to generate significant percentage moves. A move from $72 to $150 per ounce would require perhaps $50 to $70 billion of net new investment demand, a figure that could be supplied by just a few percent portfolio reallocation from global pension funds and sovereign wealth funds. Let me walk you through the short-term and long-term catalysts that could push silver substantially higher while Bitcoin remains range-bound or declines. Short-term, we have the monthly U.S. jobs report due next Friday, January 10th, and if the numbers come in weaker than expected, it would strengthen the case for Fed rate cuts, which historically benefits precious metals by reducing the opportunity cost of holding non-yielding assets. The market is pricing in approximately a 38% chance of a rate cut at the March FOMC meeting according to Fed funds futures, and any incremental data supporting that narrative helps silver. We also have earnings season beginning the second week of January, and if major tech companies that have been market leaders show any signs of margin pressure or slowing growth, risk-off flows benefit traditional safe havens like silver more than speculative digital assets. Medium-term catalysts include the ongoing debt ceiling debate in Washington, which historically creates dollar volatility and flight to safety flows. The U.S. Treasury will hit its borrowing limit sometime in Q1 2026, and political gridlock could create another near-crisis moment that pushes investors toward hard assets. Additionally, several major silver mining companies report Q4 2025 earnings in February, and if production numbers disappoint while costs have risen, it reinforces the supply constraint narrative. Companies like Pan American Silver, Hecla Mining, and First Majestic Silver will provide critical data on how tight the physical market really is. Long-term, the most powerful catalyst is the accelerating energy transition. The International Energy Agency projects that solar power installations need to triple by 2030 to meet global climate targets, and every megawatt of solar capacity requires approximately 33 ounces of silver. We're talking about potential demand of 300 to 400 million ounces annually from just the solar sector alone by 2030. Up from 160 million today. Electric vehicle adoption is another structural driver, with projected sales growth from 23 million units in 2026 to 45 million units by 2030. Each vehicle's silver consumption might seem small, but at scale, it represents tens of millions of ounces of annual demand that's essentially permanent once those vehicles are manufactured. Bitcoin has no comparable structural demand driver. Adoption is purely voluntary and sentiment-driven. Countries can ban it, which several have. Investors can rotate out without any fundamental consumption forcing them to remain buyers. The Lightning Network and other scaling solutions might even reduce on-chain transaction demand over time. There's no solar panel manufacturer who must buy Bitcoin to produce energy. No electric vehicle company that needs Bitcoin in their supply chain. This fundamental difference in demand drivers explains why institutions managing 100-year portfolios are choosing silver over Bitcoin for meaningful allocations. Let's connect all these threads to the bigger macro picture, because understanding the forest helps you navigate the trees. The global financial system is at an inflection point with debt-to-GDP ratios at historic highs across developed economies. The United States federal debt exceeds $36 trillion, representing approximately 123% of GDP. Japan's debt to GDP is over 260%. Major European economies are struggling with stagnant growth and high debt burdens. This level of indebtedness historically leads to currency debasement through inflation, financial repression through negative real rates, or some combination of both. In such environments, hard assets with limited supply and tangible utility outperform paper assets and promises, which is exactly what government bonds and even digital tokens ultimately are. The dollar's role as global reserve currency faces long-term challenges from BRICS nations developing alternative payment systems. Though near-term the dollar remains dominant due to network effects and lack of credible alternatives. This creates a paradoxical situation where the dollar might strengthen in the near term during global stress events, even as its long-term purchasing power erodes. Assets like silver can perform well in both scenarios. If the dollar weakens, silver rises in dollar terms, and if the dollar strengthens but real rates remain negative, silver still preserves value better than currency deposits. The bond market is sending mixed signals, with the yield curve having recently normalized after an extended inversion, suggesting recession risks may have passed, but long-term yields remain elevated relative to inflation expectations. The 10-year Treasury currently yields around 4.6%, while 5-year inflation expectations sit near 2.4%, giving a real yield of approximately 2.2%. While positive real yields typically pressure gold and silver, the current situation is unique because those yields are being generated in an environment where the Fed is potentially done hiking and might cut, which would steepen the curve and compress real yields back towards zero. Smart money is positioning ahead of this shift rather than waiting for it to be obvious. Equity markets have reached valuations where the S&P 500 trades at approximately 21 times forward earnings, above the 20-year average of 17.5 times. Tech megacaps are carrying the indices with concentration risk at historic levels. The top 7 stocks by market cap represent approximately 30% of the S&P 500's total value, and their average PE ratio exceeds 35 times. When equity markets are this concentrated and this expensive, portfolio managers look for diversification in value. And with Bitcoin now sporting a market cap that makes it a top 10 global asset, it's no longer the small diversifier it once was. Silver, by contrast, represents a tiny fraction of global investment portfolios, with some estimates suggesting that silver investment holdings represent less than 0.3% of global investable assets. The asymmetry of potential returns favors the underowned, underappreciated asset. Here's what all of this means for you as an investor trying to navigate 2026. Bitcoin at $90,000 represents a mature asset that has delivered extraordinary returns to early adopters, but now faces a challenging environment of regulatory scrutiny, competition from other cryptocurrencies, institutional caution reflected in ETF flows, and technical resistance that suggests limited upside without fresh catalysts. That doesn't mean Bitcoin goes to zero, or even that it can't rally from here, but the risk-reward ratio has shifted. The downside risk to 75 or even 60,000 is very real if macro conditions deteriorate or if regulatory pressure intensifies, while the upside to 120 or 130,000 requires a return to euphoric conditions with massive capital inflows that don't appear imminent based on current market structure. Silver at $72 after a 142% rally might seem extended, but the fundamental case actually strengthens at higher prices. Industrial users who have been drawing down inventories will be forced to rebuild at any price when stockpiles run critically low. Investment demand tends to accelerate as prices rise because momentum attracts attention, which is why silver's biggest moves historically happened after the metal had already doubled or tripled. The 1979 to 80 move wasn't driven by bargain hunters at $9. It was driven by momentum buyers at $20, $30, and $40 afraid of missing the move. The supply deficit means every dollar rise in price removes marginal supply that was barely profitable at lower prices, while demand remains relatively price inelastic because industrial users have no substitute for silver's unique conductive properties. The smart money rotation we're discussing isn't about Bitcoin going to zero or silver going to $500 per ounce. It's about risk-adjusted returns and portfolio positioning for a macro environment characterized by uncertainty, high valuations in traditional assets, and structural supply shortages in critical commodities. When pension funds and sovereign wealth funds managing trillions look at their portfolio exposures, they're asking what assets provide downside protection in a recession, inflation protection in a stagflation scenario, and upside participation if growth accelerates. Bitcoin provides none of the first, questionable benefit for the second, and excellent participation in the third. Silver provides moderate benefit in scenario 1, excellent benefit in scenario 2, and good benefit in scenario 3. The diversification math favors silver, which is why you're seeing these allocation shifts. I want you to comment below your price predictions for Bitcoin and silver by December 31st, 2026. Where do you see Bitcoin trading in 12 months? And where does silver end the year? I'm reading every single comment, and I'll pin the most interesting predictions with reasoning, not just number guesses. If you found this analysis valuable and want daily market breakdowns using real data, like we just went through, you need to smash that like button right now because it tells YouTube to show this content to more people who need to understand what's actually happening beyond the hype cycles. Subscribe and hit the notification bell because I'm dropping videos every single day breaking down crypto, commodities, currencies, and macro trends with the same data-driven approach you just experienced. The opportunity right now isn't about being dogmatically pro-crypto or pro-precious metals. It's about recognizing when institutional flows and fundamental supply-demand dynamics are creating asymmetric setups. Bitcoin at 90,000 represents consensus. Everyone knows about it, everyone has an opinion, and it's priced accordingly. Silver at $72 after a massive rally is still under-owned, under-discussed relative to market cap, and backed by structural deficits that mathematics says must resolve through higher prices or demand destruction. And industrial demand doesn't get destroyed easily when you're talking about solar panels needed for climate goals and electronics needed for modern life. The smart money sees this, which is why billions are moving, and you're watching it happen in real time through ETF flows, futures positioning, and physical premiums that don't lie. Make sure you share this video with anyone who's been confused about Bitcoin's stagnation or silver's explosive move, because this context is exactly what they need to make informed decisions rather than emotional ones. The data is clear, the rotation is happening, and 2026 is setting up to be the year when the crowd finally notices what the smart money has been doing quietly for months.